Hello and welcome to our Business Management Unit 7, talking about business finance. In this unit, this is our last lesson in this unit, where this is 7.3, we are talking about funding sources. So the objectives of this lesson are to debate the pros and cons of different funding sources and assess their importance, and to compare and contrast the similarities and differences among angel investing, venture capital investing, and equity investing. So let's get started. First off, let's start with business capital. Now, this refers to the money or the assets used by businesses. It usually involves some form of debt or investment, and it is essential for starting a business, daily operations, business expansion, and product development. Now, there are three main funding sources, three main types of funding. You can have retained earnings, debt capital, and equity capital. So let's talk about each of these. Retained earnings is the funds from profit made on products or services. Now, the advantages of retained earnings are that there are no debt obligations, you have complete control over the funds, and you have independent decision making. The disadvantages, though, is slower business growth, it's limited by your sales performance, and you may miss expansion opportunities. Next is debt capital. These are the funds borrowed from financial institutions. Some of the advantages include immediate access to the funds, there's no investor involvement, and you maintain ownership control. The disadvantages, however, mean that you have to make regular interest payments, you have to get approved by the bank, that's required, and it can affect the company's credit rating, and there's a risk of default, which means you don't pay the bills. Next is equity capital. These are the funds received from investors or from selling shares or stock in your company. So the advantage is that there is no repayment required. You get immediate funding access, and there is a shared business risk. So not one person is taking on the risk. The disadvantages, though, means that there's investor accountability. You have to be accountable to your investors, and there's a shared decision making. And very often there's regular performance scrutiny. How well are you doing in your business? So let's take a look at something called angel investing. This is an early stage funding for startups. Now, its key features means that you're getting money often from friends or from family. It is a high risk investment, but it is common in startups. And you may include ownership rights, and there's direct input from in-company decisions. Now, again, angel investing is a high risk. It's early stage, meaning you're just starting your business, and there's a lot of personal involvement in it. Next is venture capital. This is growth funding for established businesses. Now, its characteristics include that it's based on previous success, it requires growth potential, and it is a medium risk level and often done by professional investors who have performance expectations. Again, venture capital is a medium risk, it's during your growth stage of your business, and there's professional management involved. And then there's equity investing through the stock exchange. This is public investment through share ownership or stock ownership. Now, the important aspects here include that there is an SEC, or the Securities Exchange Commission, oversight that is required. There's ownership dilution. That means the ownership is spread amongst whoever is holding stock in the company. Shareholders have voting rights in what goes on in the business. You have to make regular financial reports that are made public so everyone can see it. And there is also market performance pressure. Again, this is a varied risk. It opens things up. This is for more mature stage businesses, and there's a lot of public involvement in this. Some of the key decision factors when it comes to stocks is that depends on, well, for any of the investing methods, it's really what stage your company's in, the growth goals, your control preferences, and how much risk you want to tolerate. So that is our lesson 7.3 of our business finance unit. The objectives of this lesson were to debate the pros and cons of different funding sources and assess their importance, and to compare and contrast the similarities and differences among angel investing, venture capital investing, and equity investing.